I have with me right now Rohit Agarwal. He's Equity Fund Manager at Kotak Life Insurance. Thank you so much for joining us, Mr. Agarwal.
Thank you.
Give me how you've changed your views over the last 10 days as to the impact of demonetization. Or were you more or less, or have you stuck to the same view for the last 10 days?
Well, for the last 10 days, which have been unprecedented in the Indian history actually, we haven't gone around and changed too much in our portfolios. What we have done or what we have come around is the understanding that the economy will be more sluggish in the near term to a slightly medium term. But the moment you start taking a medium term to a longer term view, we believe that the kind of positioning which we had earlier does not need to necessarily change. What has certainly changed that there is a near-term impact on demand, there is a near-term impact on the currency which people have in their hands, and hence the capability to spend goes down. But as we move forward, we believe that as the RBI starts to, and the banks with the RBI start to give more money in the hands of the people, the figure right now is 1.4 lakh crores, and we understand that the deposits is about 6 lakh crores. As this figure starts to increase, this 1.4, we believe that the economy will start to improve and things will start moving. However, the demand destruction in the near term is here to stay, and we believe it will take a little longer for it to come back. But one point I would like to make here, that we at Kotak Life believe that most of the market participants are ignoring other side or other aspect. The demand destruction is for everyone to see. But what about supply? There are some segments, there are some sectors where the shift to unorganized to organized will actually accelerate. People were expecting that after the GST, this shift will happen. But we believe that this move by the government of the demonetization will actually accelerate it even further. And in some of the sectors where the unorganized sector is a higher component, sectors like tiles, like plywood, even sectors like cement, where there are some small regional players which are pretty unorganized, the shift to the organized will be pretty swift, and over the longer term it will benefit the branded players, the listed players.
Let me be the devil's advocate here and ask you a question. When you say that the shift from unorganized to organized is going to be relatively swift, and you'd said earlier that GST was going to do that slowly, but this has more or less done it in a surgical manner. You know, the unorganized sector or the small sector kind of employs 80% of people. That's the conservative estimate. Some say that probably 90%. If I look at the small and medium enterprises, they contribute about 45% of GDP, 45% of output, which is about 13% of in terms of manufacturing. Trade, 10 crore small traders. They employ 46 crore people overall, the small informal sector. Now, when you say supply is going to increase, but demand is going to go down, then I would imagine that there's going to be pricing pressure. There's going to be a problem with pricing for many of the players who go through this organized retail system.
No, we believe supply will contract. When we say we talk about supply side pressure, what people are talking is demand side pressure. We believe that there will be supply side pressure. Today only we heard about a large cement company making a bid for a small regional player. Now this is something what we have to watch out for. What will happen is people who are organized, who have large balance sheets, will look out for some people where there are synergies, but for people who are small, who are regional, but have the assets which can add value to that larger guy. And hence you will see a larger number of mergers and acquisitions happening through, where the strong will become stronger and the weak will likely fall out.
Now, what's the impact of that on equity market?
The impact of that in the longer term,
yeah.
On equity market in the longer term, actually it's very, very beneficial. As you see, that 6 lakh crores has been deposited into the accounts, into the banks already. All of it will not stay. Some people believe that 70-80% of this will likely go back into the system.
Right.
However, we believe that a lot of the money which has come into the banking system already, that will get channelized into financial savings like mutual funds, like insurance, like ULIPs, and all other instruments which are available. Now that the shift from physical to financial assets is happening, we believe this whole shift will accelerate at the margin, and the whole financial system as a whole will benefit. People who have technology, people who have financial products will actually benefit in the longer term.
But let's just break it down with an example. Let's say someone had 2 lakh rupees stashed up at home, and not necessarily black money. This is something that they just had around because this is what they'd taken out. Or, in families in North India, we hear, and even South India, we hear that women keep a certain amount of money saved as emergency fund. Let's say that they go into the bank, deposit it, a certain amount they might take out, but as you said, that since this was an emergency fund, unlikely that they'd turn it into cash immediately. This money sits as a liability on a bank's book. It is not an asset, because this is something on which the bank has to put out, has to give out interest. Chances of it remaining in CASA is, relatively slim, because if I am forced to put money into a bank, I'm likely to turn it into a fixed deposit or a recurring deposit which earns higher interest rate, which means that the cost of fund there is slightly higher. Some of that goes into the stock market, it goes into life insurance products, and a person like you will have to go and invest it out there. When there is a demand contraction, when there is a slowdown in the economy, it becomes tougher for you to go out and put money in, right?
Not necessarily. See, we believe that demand contraction is temporary and it will come back. However, the demand, a relative comeback of the demand will be different. The degree will be different in different sectors. For example, the degree will be slower in discretionary consumption. The high-end items will take longer time to come back for consumption. But if you look at the consumption at the lower strata of the economy, things like soaps, hair oil, shampoos, these things will come back pretty fast. And if you see all of this, where we have heard even the RBI spokesperson and others talking about that there has been some misuse where people have been using for exchange or the Jan Dhan accounts, what this will do is that it will increase consumption at that lower strata of the economy, and hence some demand uptick will be seen. Now, demand, what we have to see is after the 15-20 days or maybe after December 30, when things start to normalize, which sector sees relatively comeback of demand at a faster pace, and that's where the relative money will move. In the meantime, if we have all seen that the bond yields have already moved down 40-50 bips, that also gives a lot of cushion to the equity valuations. You could see the utility companies doing well, which is already happening in the market. Logically, if this bond yields were to stay low for another 6 months, you could see the whole Indian equity market getting re-rated because of the just the risk-free rate or the bond yields that people put into their models. It will take time. We all agree about that. But slowly and surely the economy will come back, and it will come back stronger on a better wicket. And as we know, equity looks out and looks forward. From that perspective, the equity market looks actually really good for the long-term basis.
Okay, before I go into sector-specific issues, I just want to again get your sense on what you are seeing in terms of the global impact. Now, you're seeing bond yields are dropping. There is a general sense that over a period of 1 year, almost all banks are going to lower interest rates. The RBI will cut rates once or twice or do something which will bring rates down. On the other hand, in the United States, rates are going up. We're already seeing bond yields as of today on the 10-year T-bill is about 2.36%. Over the next 1 year, some people are saying that there'll be 4 rounds of rate hikes done by the Fed, US Fed. Now, when that arbitrage in terms of interest rates goes down, the tendency of the dollar to strengthen against the rupee, then foreign fund flows are unlikely to be at the same rate, right?
It is possible, but it is not necessarily something that we are believing it will happen with a long-term basis. The reasons are as follows. If you see what's happened in the last 15 to 20 days, barring the Indian-specific issues, as you yourself said, globally bond yields have gone up. If you see the emerging markets itself in the last 2 weeks has seen more than $5 billion of equity outflows. So India has seen its fair share of outflows. So it will not be correct to actually put India into a spot and say that this has happened because of the demonetization. As you yourself said, it is a lot globally led. But at some point, the globe issues will settle. Right now, global bond yields are going up and Indian bond yields are going down. We are not necessarily used to that kind of a scenario. Having said that, India is in a unique situation. where, as you yourself pointed out earlier, there's a lot of CASA deposit into the banks. Inflation is likely to trend lower because there is a demand destruction in the near term, and hence interest rates will be lower. What will happen next, what we believe is that you will have to watch as to how the RBI and the government are able to kickstart the economy. It is very unlikely that there will be a new plethora of private sector capex. So the RBI and the government, where they are likely to have 2 lakh crores to 3 lakh crores of money by different estimates, by different experts, how that money is channelized into kickstarting the economy, how that money is channelized into pumping the economy, and how that is channelized into various welfare and social schemes, which gives the confidence to the people that the economy is on the right track, will determine the future of the Indian economy and hence the Indian markets.
So let me now go into the sectors. Mr. Agarwal, before this particular event happened, a once in a lifetime event happened, were you more consumer discretionary facing? Were you more financials facing, more home improvement facing? Is that bet going to change a little bit in the near term?
Little bit. So we were, before this event, heavy into the financials, consumer discretionary and the home improvement, yes. But that hasn't changed a whole lot. For example, we may have trimmed down a little bit into the home improvement space and the consumer discretionary space, but we haven't trimmed down into the financial space. If anything, we have actually upped our stakes a little bit on the financial space.
All right, if I had to divide that financial space, would you have a different take on NBFCs right now?
Yeah. So even in NBFCs, there will be NBFCs which have a lot of collections in cash, and although almost every disbursement happens by check, so the NBFCs where a lot of collection happens by cash, those are the NBFCs where we believe that normalcy may return little later, and it may take a little longer for things to get back on track. We actually do not necessarily know that whether going forward their business models itself will be questioned, although we think not, but in some way or the other they will also have to start moving towards a lesser and lesser cash collection. So we'll have to see how their business models evolve. So yes, on the NBFCs which are more rural focused, which are more cash collection focused, we have seen trimming of our bets. Having said that, we were largely not there in that space even before the event.
Okay. Some are arguing that this is the death of NBFCs, because by the 30th of December, a large part of India will become banked, will have access to regular banks, because perhaps they won't need to go to NBFCs anymore for MFIs anymore for their loan requirements. Big banks will be flush with funds. They'll find it much easier to lend out to the last mile. Cash component in last mile lending is going to go down. So effectively, NBFCs are more or less wiped out.
We do not necessarily think so. NBFCs exist in our system because they serve a specific purpose. It is not just the ability of the banks on the side of the liabilities which is the hindrance for the bigger banks to go out and lend. It is the whole process, it's the whole setup. It's the ability of the banks to evaluate the credit at the right micro level on the ground, which is very, very different from an NBFC, especially some of the NBFCs which have been around for 20, 30, 40 years, have deep understanding of that business, of that customer, of his mindset, of his behavior. Right. If that were true, what you were saying were true, there have been cycles in the past where if not such an event, but events of liquidity pressure has happened on the liability side. But barring short-term pressure, these NBFCs have come back. It's not that the bigger banks have not tried to get into that space. They have tried. But you see that the moment a cycle comes, a credit cost cycle comes, these NBFCs have demonstrated that they have better ability to manage risk, to evaluate risk, and hence come out winners. So we believe that there is space still in the system for NBFCs and banks to coexist, and they will continue to coexist. There will be a little bit of the tweaking of the business models, which adjustments all of them will make. For example, most of the NBFCs that we have spoken to after the event have told us that they have started giving the bank accounts of their details of their companies to the borrowers, and some of the borrowers are actually going and depositing their cash in those bank accounts. You just have to give an authority letter. These things will happen, things will change, the way the business is done will change a little bit, but the heart and core of the business will remain the same, which is to evaluate the credit, to evaluate the person, and to be able to take the right credit call, which is the expertise of these NBFCs, and that is why they exist. We believe they will continue to exist.
Before the 9th of November, when these two things happened, demonetization and Donald Trump's victory, what was your position on IT and pharma?
We were underweight both the sectors. However, if you see look at both of these sectors, pharma has been a relative underperformer even before the event, and they had their own sets of issues with the US regulator, the US FDA, and some of those issues were starting to get resolved. Pharma has always been what we believe a bottom-up sector, and hence in pharma you always pick stocks rather than the sector itself.
And in terms of IT, what is your view on IT?
IT, we were relatively underweight going into the event. Even after the event, we haven't really changed too much, maybe a little bit here and there. That is more to do with the relative positioning. We believe that IT sector in the longer term faces challenges. Having said that, the sector is not expensive. It is a relative beneficiary of rupee depreciation, which has been around 2%, though not too much of it flows down to the bottom line. What it does is it maybe has a cushion on valuations. There is maybe a floor where you are not unlikely to see a lot of meaningful deceleration in the multiples, where most of the large cap Indian IT companies trade at 14, 15 times 1 year forward, although the earnings may not be very great. But now, after the 8th of November, after the event, some of the other sectors will see larger earnings cut, and hence IT starts to look better on a relative term. Hence, in the near term, you could see some money shift towards IT and pharma. But in the longer term, we do remain slightly concerned about the long-term prospects of the IT industry. Their ability to grow at mid-teens or maybe higher teens is a little questionable right now. But we believe even those companies and that sector is working hard to work out business models where they can reinvent their businesses and come out with solutions where they can grow at a healthier pace.
In terms of real estate, before this event had taken place, there was a sense overall in the market that perhaps real estate has bottomed out. The pain is now almost over, and they're selling at such ridiculously low valuations that perhaps it's worth buying. But now that seems to be, the consensus seems to be that process has been postponed by another year or so. Were you taking bets on real estate before this event took place?
No, we didn't have real estate exposure before the event.
All right. A lot of the funds also have exposure to what the lower end of consumer discretionaries, things like leisure, for instance. You've seen a lot of funds exposure to the PVRs, the Inoxes of the world, the casinos and things like that. Are those going to be affected right now?
Right now, a little bit, yes. But again, we will need to distinguish and make some adjustments to our thought process. You have to look at city-wise. So we have to look at, when we look at a company, we look at the whole portfolio. Now, without naming companies, if you see even say film exhibition, the names that you have been talking about, in a city like Mumbai, the impact is relatively lesser because people here use a lot of mobile apps, people use a lot of credit cards, and hence the payment through online is pretty decent. The same is not true when you move to tier 2 to tier 6. What it does is, in our opinion, again, as we said, that longer term it is actually accelerating the whole process. If you speak to any company, any bank, any credit card issuer, all of them have told us that their transactions are up 2x, 4x, 5x. Right. What that tells us is maybe some of it is forced, but people are getting used to using plastic money. People are getting used to getting online and making their bookings and paying via credit cards, debit cards, all of that. All of this basically is a lower cost for all of these players in the longer term. So barring short-term disruption, it is actually good for them, where lot of people are getting into their domain and using their apps and making the purchases where they don't need necessarily to reach out to them. So it's actually a pull impact rather than a push impact which is a much more longer process. Now the pull impact, it may take time, but it's a lesser cost and lesser time consuming.
All right, on that
Barring
very
the short-term
positive note.
disruption, which is there on demand.
All right, on that very positive note, thank you so much for joining us, Rohit Agarwal. Pleasure talking to you and hope to see you soon again on our channel. Thanks a lot.
Thank you so much.